life. And so even though it might be beating a dead horse, I heard that you have to hear something 7 times before it really sticks in. So, hey, I'm beating that dead horse the second time. Okay, so I have here the seven hidden secrets about whole life insurance our community should know. And before I get started there, I wanted to go into just introducing my company, Insure Financial Group. My father and mother actually started their insurance agency in 2005 after being agents since 2002. And now we have a total of 16 agents in Florida, Georgia, and North Carolina. Something that we're proud about is last year we received the Business Excellence Award from the Lakeland Mayor, Bill Mudd, here in Lakeland, Florida, and we're rated an A plus with the Better Business Bureau. On the next slide, I wanted to jump right in into the first secret. Now, this is something that Chad did discuss earlier, was the features of that whole life being tax-free. And so I did want to give you guys some books as well because, you know, sometimes you need that affirmation from books that say, yes, this is the right track when it comes to life insurance. So Become Your Own Banker by R. Nelson Nash, Money, Wealth, and Life Insurance by Jake Thompson, and Rebecca Walter. Here in Florida, she's very popular. She's a tax CPA that just talks about the benefits of whole life insurance as well. So as you can see in this slide, when you're doing those 401k, 403b, if you have a government job or work for the school board, the 457 plans, when you pull money out of there, you're getting 30% tax going into the government. And so my father always says, and I'll quote him a lot because that is my mentor and father. He always says, what did the government do to earn that 30% cut of your funds? Because if you wanted to pull all that money out, it's going to the government. 30% is going to the government. And then if you're investing in stocks and things of that nature, 20% is going to the government. But with whole life insurance, when you're putting money into your whole life insurance plan, one, many of us know that the death benefit is tax-free. But two, there's a strategy that can be used where you can pull the cash value out tax-free as well. And that's something that we meet with clients and actually educate them through their policy to see, let me evaluate what you have and show you the difference between our policies and the policies that you might have and how you can actually use your whole life as a strategy to have no taxes and no fees in it. So if we go to the next slide, I just broke it down to make it very plain. In the next slide, it has example. For some reason, the next slide's not showing. But in the next slide, we see like that last bucket, the tax deferred. You had 300,000 in the tax deferred 401k. You try to pull all that out, you're giving a $90,000 cut to the government. If it was taxable, you had it in the stock markets, you pulled 300,000 out, you're giving them 60,000. But if you had 300,000 in that cash value whole life insurance policy, you wanted to pull that money out, you're not paying taxes on that money. And then on top of that, since that was just the cash value, if you did not pull it out and transition, you have actually a death benefit of $500,000. So we're already seeing that, hey, in this bank, not only does it have the feature of I have access to the cash, but I actually have split my money in a way where it is increasing for myself and for my beneficiaries when I transition. So if we go to the next slide, I wanted to actually highlight the other 6 benefits of whole life, those hidden secrets, which we talked about earlier today with Chad. He was saying about it being tax-free. But that guaranteed cash value is one of the major difference with the whole life. So when we're talking about life insurance, we know we're talking about the term, the whole life, and the index. Well, the whole life is something that is not an investment. This is where you want your safe money. It's your guaranteed money. So when you talk about whole life, it has guaranteed cash value and then a bonus of dividends. Now, this means that the company is a participating whole life company. It's a lot different than the insurance whole life plans that our grandparents knew, where the insurance man would come knock on your door and get that $30, $40 a month and give your grandparents that $10,000 plan, because that whole life was saying that, hey, you asked for $10,000 to pay for burial, and that's what you're going to get. It doesn't take into consideration that if you got that $10,000 plan when you were 45 and you had some children, or the grandmother who had some grandchildren that she realized, oh, I need some life insurance for these babies. If she got that policy at 45 or 50 and then paid on that $10,000 policy in her up into her 80s and 85s, the company that you asked them only for 10,000, you've more than likely given them $15,000 to $20,000. And what company deserves a $10,000 or $5,000 tip when they only are going to give you what you asked for, which was 10,000. So that is a non-participating whole life policy where we're talking about a participating whole life company that provides guaranteed cash value that's growing, dividends as the company is profitable, and then something that the guy that was asking, well, if I don't have children and I don't have a wife or someone that I don't want to leave funds to, why would I need a whole life policy? Well, with the whole life policy and its guarantees, what you can do is guarantee cash value in your retirement years, where the money that you were putting in there, if you had 200,000, like we talked about earlier, in that cash value, and you've decided that, hey, I don't have anyone to leave the death benefit to, let's spend down that cash value in your retirement years as an annual check, and now you've created another retirement income generator. And that right there, I gave y'all for free, but I think it's phenomenal to see how that works individually. So it's very important to do this on a case-by-case method to see what your budget is, which we're going to talk about in the next slide. But before I get off this one, the next one is the tax-free. This death benefit is going tax-free to your family. If you don't have a family you want to leave it to, you can do a charity or a church. And that's something that's very popular in other races, and they leave money to the foundations of things they want to be sustainable and still there when they're gone. So their schools, their colleges, the Catholic churches, they're leaving life insurance so that those funds are helping sustain that thing. And that's what we need to do in our community with our businesses. If we want our businesses to still be here when we're gone, we leave the funds so that business can still go on. The next one is the full life coverage. A lot of people don't know this about whole life insurance, because usually it's like, okay, I got to pay for the rest of my life. But actually, you can have a whole life insurance plan that's done in 10 years and good for the rest of your life. Now, that is a major key that we're going to show later as well, but it helps you take care of something, because a lot of the millennials my age, we want to see that there's an end in sight. This is not a bill I got to take for the rest of my life. Well, if you take in consideration a certain amount of funds that you want to put away in life insurance, you can be done in 10 years and have a whole life plan that's good for the rest of your life. And the last thing is that no early withdrawal penalty. So when we know about 401ks and 403bs, if you're trying to pull money out before 59 and a half, not only are you going to be taxed, but you're going to get that penalty. With whole life insurance, there's no early withdrawal penalty. So that is something where, hey, that's my money. COVID happened. I want to pull out from my cash value. Well, then you have access to that within 48 to 72 hours. There's no questions about your credit score or your employment. No, those are your funds that you've been storing up for a time as this, and now that time has come, I need to pull money from my account. And so we saw that with COVID, that was a great strategy for our clients that were able to say, hey, I didn't know I was going to lose my job, but now I have a cash value I can pull from and borrow from myself. So if we go to the next slide, I wanted some interaction here. I don't know if I'm going to get it, but I wanted to show you all, when we go to our churches and our community centers and educate on becoming financially aware, that disposable income, what we're doing with it. If I could ask you, Jalinda, how much do you think your family usually spends eating out a month?
My husband is a big guy, so I would say I'm working on that budget, but we could go up to 250 pre-COVID. We're going out to eat just at his favorite restaurant, that's very easy to do.
Exactly. That 250 is very common. That's what we see in churches. And then I even met a family where their daughters alone spend $400 a month just eating out. That's just what they do. And so we calculate eating out, hair, nails, and cell phone, all of those activities, and you're spending $1,050 just in those activities alone. If you do that repeatedly monthly for 12 months, that's $12,000 you put into those industries. If we do 12 times 10 years, you've given almost 6 figures to these companies to maintain the lifestyle. And what would you say you have to show for that in 10 years, Jalinda? What would you say we have to show from eating out, hair, nails, and cell phone, the bundle, and things of that nature?
I say absolutely nothing.
My dad says hips, butt, gut. If we could go back really quickly, my dad always says the only thing you have to show for that is hips, butt, gut, and thighs. I think you could press the arrow button back on your keyboard, it might work. But yes, so we'll say that all you have to show for putting 6 figures in that industry is a good time, or just eating out. You'll see that as well. But if we went back to the Red Lobster there, that's the ultimate feast. I had that for my birthday. If you go there and say, "Hey, I put over six figures into this business, but COVID happened and now I can't pay my mortgage. Could you give me just $1,000 to pay my mortgage?" They're gonna say, "No, that money has been spent. We've already spent it. It's gone." If you wanted to do that, you would have had to put something aside for yourself. So a lot of people say pay yourself first, and usually when we hear that, we just start putting money in the bank. But there's a way through whole life insurance that you can guarantee you have funds there, and if anything were to happen, you have access to those funds. And if you didn't touch it, then your family would have a death benefit if you wanted to as well. So now we can go to that next slide. And since we said we're spending $1,000 a month eating out and living our lifestyle to make us happy, we have to consider that while we're doing that, there's a lot of things happening in life. So we see birth here, but then we also see that someone goes to college. That's actually me. I graduated from FAMU, had to show off from my school. But actually, when I was in college, I got in a car accident. A month after bringing my car on campus, I got in a car accident and totaled my car. Now, just 3 years earlier, when I had first got on campus, I received scholarships to the fact where they gave me an additional 6,000 in scholarships that just was extra money. But not knowing to store and put things away, I assigned that money to food, clothes, and everything else that felt great to me, some new hair. And so then 3 years later, I'm like, man, I just totaled this car and I don't have the funds to pay for another car. So I had to go a month without a car before I could get some funds back in to pay for a car. But that life challenge right there could have been changed if I would have known about the whole life. And so we know about when we're going for a job, you get life insurance on your job as well. And so a lot of people, they stop there. They say, "Oh, my life insurance on my job has me covered." Well, do you plan on staying with your job for the rest of your life? Or can you take your life insurance with you? And so it's important for us to know that most life insurance stays with the job because that was a benefit of working on that job. And so really it's critical for us to have life insurance outside of the job just so that we are covered for every life event, because we see here with people aging and with COVID, those are challenges where last month you had a job, but then when COVID hit and they started terminating people, now how long can you go without a paycheck before you lose the house or lose the car? Well, if you had that built up in a cash value whole life plan, you can go some months with that while you're looking for a job and just you borrow from your whole life policy. So now we can go to that next slide. That next slide shows that this is a 2-year-old, Jane Joe, she's 2. Her parents are like, "You know what, we need life insurance on her." As Chad said earlier, the younger you start, the cheaper it is. So for $76 a month, that purchased $100,000 in whole life insurance. And then so when she's 12, this policy is done being paid for. It's good for that 100,000, but it also has a cash value of 8,000. But Jane Joe's not the owner of this policy, her mother is. And so her mother, if there was any kind of incident, she has $8,000 she could pull from that policy. But let's say she didn't touch it. At 30, she decided to make Jane Joe the owner of her policy. That policy that she only put money in for 10 years now has access to $24,000 in cash value. Where Jane Joe is like, "I want to start my own business. I want to go to the bank to get a loan." Her mom says, "No, I have a whole life policy where you can pull out $10,000 and start purchasing a building that you want to start your practice in, or something of that nature." But the thing that hasn't changed is this policy is continuing to grow the rest of her life. And so when she's 80, something that her mom did for her from age 3 to 13 now is worth $450,000 in death benefit to her next generation, but she has $321,000 in cash value. And so a lot of people would say $76 for a 2-year-old, that's expensive. Compared to what? $76, we could put that in a couple cute little outfits for a baby easily. So why not put that on our child and have this something where they look back at you and say, "My mama did this. I got her name up on a plaque because she left me 6 figures in this strategy." So we go to the next page. I just showed you a breakdown of a 30-year-old who says, "Hey, I want to do a 10-year plan as well." Because a male, it costs more for a male to get insurance than a female because they say females live longer. $250 would purchase $125,000 in whole life insurance for him, but when he turns 40, it's worth $142,000, and he has access to $30,000 in that policy. And this is what I like to show people my age, because we like to see an end in sight. So something that he stopped putting money in at age 40 has all his money back right there in the cash value, is now just building him money. So when he's 45, he has access to 40,000, but he hasn't put money in since he was 40, and is continuing to grow. So what else do we have that's our money making us money, and that's guaranteed? This is something that we want. Whole life gives you those guarantees, and that's what I wanted to highlight today. And so if we go to the next page, I just showed I think a 50-year-old with a different budget. He had 124. Because he's older, he wasn't trying to do the 10 pay. He just wanted to see what he could get with $124. He can get 65,000. When he's 65, he has 23 in it, and it's worth 78,000. But it's continued to grow, and this is a whole life policy, so there's no additional fees that comes with that. The next slide is just the last life insurance tip. If anything, the thing I love about whole life is this something that you can set and forget. You do not have to worry about the premiums changing, things of that nature. And it's something that is not an investment, so you don't have to watch it. It's just a way to systematically save and pay yourself first. And if you need something for an emergency, the money is there. So I've left my contact information here, and I had another page of frequently asked questions. But if you guys have any questions for me, I would love to answer.
So now is the time for any of those questions that you guys might have for Ms. Jalinda.
A question, Jalinda. This is Kenya. Just to understand the whole life policy. So I am in my 40s, and so I do have 2 children that are college age. So if I wanted to start a policy, is the premium, and let me make sure I'm asking it correctly, is the premium only good for 20 years and then I stop paying on the policy? So I could could you upfront your premiums? That's I guess a part 2 question, and be done and still have that same cash value benefit, or does it have to sit there over a period of time in order to gain that benefit?
So I kind of missed the first part of your question. You were saying you had a child. So what I was showing you earlier is that you can pay for 10 or 20 years. It's completely up to you. And yes, you can set it up where you pay for a whole life policy for 20 years. And at that 20-year mark, you don't have to put any more funds in, and it is good for the rest of their life. And then you wanted to know about the if you put the money in up front. So if you had like a lump sum of funds that you wanted to put the money in up front, then you could do that as well, so that you can have access to a good amount of the cash value. So it would be completely up to you to decide what strategy you wanted, and we would just design it for you. So what I would say is I would show you on an individual basis how to create that plan that meets the need that you want, but it can definitely be done where you have cash value early on. So it would be us meeting individually to talk about that.
Great, thank you.
I
have a question.
Yes, sir.
Chris Bassett speaking. When you say that, I guess the cash value of the, should I say I guess the growth of the cash, available cash in the policy is guaranteed. What vehicle? I mean, how is it possible to guarantee a return? That's my question.
How is it possible to guarantee a return? So like what was mentioned earlier in Chad's presentation, where you had the cost of insurance was about, if they were putting $3,000 in annually, which I want to break that down to monthly really quickly, which I should know this, but I'm going to do it anyway. $3,000. So he's saying $250, a third of that is going to the actual cost of insurance, and the rest is going to the cash value. So what the company is saying is that out of your monthly payment to us, we're paying for your insurance costs, but we're also putting some in cash and allowing you to have access to that. And so what I've seen with these mutual companies is they actually guarantee an interest of one of the companies I'm speaking of, they guarantee an interest of 4% on that cash value. So it's guaranteed to grow at that rate. And so that's basically what the mutual company offers. They offer a guaranteed cash value interest rate of 4%. And depending on the company, they have an additional dividend as well that they put into your policy annually. Does that answer your question?
Well, yeah, years ago, I had someone who tried to, sell me on annuities, and he was saying the same thing. It's guaranteed return. My thing is there has to be some kind of underlying vehicle that generates this additional money, and that's what I'm trying to get an answer to. Like when I even asked that question to him at the time, and this was decades ago, he couldn't give me an answer to the question. It's like, okay, so you're saying a 4% is guaranteed. I mean, right now, if you put money into a bank account, you can't get 4%.
Exactly.
So I mean, the thing is, the 4% comes from what type of investment vehicle? It's got to be coming from something.
Well,
I mean,
the whole life insurance company, the mutual companies, they do pool your risk with the other client insured. So they have their own strategies of how they're using different bonds and stocks of their own to secure those funds. But by law, the insurance companies have to have money on hand to pay off every single insurance policy. But since those risks are pooled, I think the only way to actually know that question would be to ask them specifically what they're doing and how they're investing those monies. But they have the strategy in place. Like the company I'm speaking of has been in business since 1909, and that's 111 years of service. And on top of that, they had 98 consecutive years of paying a dividend. So that means that not only did they guarantee that 4% interest, but they also had a profitable year to put a dividend in there as well. So I think annuities are a little bit different than the whole life plan, but the guaranteed whole life is where they actually guarantee, you will see in the illustrations, the guaranteed column of that cash value interest rate is guaranteed each year. And I have the plan myself, and I've seen it actually do exactly what they said it would do.
Okay. Well, I mean, who are these underlying companies that are actually, I guess, managing the funds? Because you're saying that what you're describing right now is what they call a dividend king, a company that pays out, and I forget exactly how many years it is. It's dividend aristocrats, dividend kings, depending on how many years of straight dividend growth these companies have had. I'm a dividend investor, so that's one of the things that I do. I look at companies that continually grow their dividends over years.
Yes, sir. Well, what I would say, just for the sake of time, is one, I would talk to you offline and actually give you those companies. But
Okay.
two, there's you can just a brief Google search will show you those top dividend paying companies and show you that structure as well. But if I can talk to you offline, I can send you that document that shows how they break down what they're investing in.
Okay.
So I actually have a question too, Ms. Jalinda. My question is, when you talk about the cash value and then you talk about the death benefit, can you have both? So if I take the money out for my cash value, am I still entitled to the death benefit? How does that typically work?
That is a phenomenal question, and I'm glad you asked that. So with the whole life insurance, like he said earlier, if you're paying $250, they're paying for the death benefit, but they're giving you some access to the death benefit while you're living and calling it a living benefit, because what they're saying is, hey, if you pass away, we would give your family $100,000. But because this is whole life insurance, we want to give you access to some of that $100,000 while you're living. So it's not the cost of the cash value and the death benefit are not two different vehicles. It's one vehicle. It's me telling you, if you pass away, I'll give your family $100. But while you're living, if you want to borrow $20, borrow $20, and I'll just give your family $80 because you already borrowed $20. Does that make sense?
That does.
So it's all the same. It's the same thing. So there's no separate piece of whole life cash value, and you can't get both. It's one bucket, and you're pulling your risk into one bucket. If you pull money out before you pass away, they're like, hey, we gave you 20, so we'll give your family the rest of the 80.
Awesome. Thank you so much.
No problem.
Yeah, I got a quick question in regards to that also. Now, when you say you take the money out, we're assuming that you're borrowing the money
Yes.
with the intention to possibly pay it back?
Yes, sir.
Okay.
And that's how you don't get taxes. You borrow it from yourself. Well, you're actually, not to get technical, but yeah, you're borrowing the money with the intention to pay it back. But if you don't, they just take it from the death benefit.
Okay. Now, if you borrow, well, if you borrow the money, okay, and some of that money is the result of the investing, the underlying investing that gives you the 4% return, and you don't pay it back, does that incur a tax penalty?
Again, because you borrowed it, if you were to transition, they would just take it from the death benefit.
Okay. Now, I mean, talking about this in terms of you borrow something, you borrow money that grew because of an investment. So, and it's not just a contribution that you're recouping. It's also it's also income.
So let me say this: when you borrow from your life insurance policy, you're actually not borrowing from your cash value. Your cash value is still growing at that 4%. The dividend is still growing there. You're actually borrowing the company's money, loaning against your money. So they're using your money as collateral, but they're loaning you their money. So when you actually transition, the money you borrowed from them, they're saying, hey, well, you transitioned and we gave you 20. We'll just take that 20 out of the 100 that we offered you.
Okay. Well, I guess that leads to a third question. Can I borrow more than I actually contributed? In other words, if my policy is for, I don't know, $200,000, and my monthly payments or my yearly payments are, I don't know, $1,000. So I'm 3 years in, I paid $3,000 in. Can I borrow more than $3,000? Can I borrow more than I actually paid at that current time?
So, Mr. Chris, for the sake of time, I would love to show you in the illustration how it actually charts out exactly what you can pull from the policy at any year. It'll show you exactly what you can pull out.
Thank you, Jalinda. And for the sake of time, Chris, yes, we are going to ask that you have that one off